Good afternoon, everyone. Uh, Thank you so much for having your presence in today's, webinar with us on behalf of Enam AMC. I express my gratitude to each of the participants joining us on the call today. For not only the support that you all have extended to us, but even the faith that you have always entrusted with us as a valued partner, as well as to the families who are joining us on the call, who have given us a portion of the long-term equity allocation, from the India dedicated equity asset point of view that we are today representing to you. I'm very happy to state that I have my colleague and portfolio manager at Enam AMC, who is the lead manager for the Enam India Vision Fund, Mr. Raghvendra Reddy, joining us on the call.
Hi, good
Uh,
afternoon. Good afternoon to everybody.
this call is the third update for us, which is the Q3 update on the Enam India Vision portfolio that we launched, almost a decade, post the initial distribution fund launch of ours, which was last year on 17th of Jan when we launched this offering, with the same ethos, the same framework, the same positioning that we have as a entity, being focused on a listed equity space. And I'm very happy to state that as I speak with you, in the last 12 months that we've gone live with this strategy of us, we have crossed, at the start of this year, 500 crores, of an AUM, which is talks a lot about the faith that has been extended once again, and I thank you all for your conviction in Enam as an AMC. What we're going to do in the call today is the first uh, 15, 20, 30 minutes. We would obviously like it to be very insightful and engaging, as we always prefer that mode. Uh, as you were aware also, as a house, we've been focused on only one asset class, which is listed equities, right from 1984, the legacy that the group enjoys. And even as a portfolio manager, that we've been in existence since 1997. And as you all are aware, we are not only one of the oldest, but we're also one of the largest, PMS provider in this part of the world, focused on a single asset class, which is listed equities. As an entity, as an investment specialist, we have always approached markets with a lot of conviction and with a lot of thought process that we as a team, which is one of the largest team at the HEM, at a 17-member investment team that we have today built across at the AMC level, that practices absolutely the stock picking at its best towards the discipline that we follow, and that's how the construct of the portfolio comes across for us at Enam. And very happy to state that today, at an AMC level, the AUM that we manage is $4.5 billion of AUM. Which has been entrusted with us, which makes us one of the largest in the country from the size of the assets that we manage on the listed equity space. Uh, with this introduction, I would pass it on to my colleague Raghavendra Reddy to walk us through the presentation that his team has created. For today's webinar, which we always do, we have broken it up in two parts. Uh, First part is the macro, the way we look across at Enam. We've always been obviously very optimistic, and perennially we've been positive as an entity, and that's how we have represented ourselves in the journey so far in the capital markets and with yourselves, while being partners across the market cycles that we have been experiencing. So Raghavendra will walk you through the macro, the way we look across the current juncture that we have, which are obviously very historic times for us as a nation that we are today, representing, and also as an entity that is participating in the listed equity space. And the second part of the presentation will be an update on the Enam India Vision portfolio in terms of how the positioning of the fund is, in terms of the strategy that we have adopted in the last 1 year, and what is it that today we're looking at for the following year. That is how we are going to structure this call over the next 20 to 30 minutes. And we would request you to put your questions in the chat box on the question and answer box while we are going through the presentation and this discussion, that we would like to keep it very engaging. And we would do our best to answer as many questions as possible, once we take, the session to that level. Raghavendra, over to you. Thank you so much.
Thanks, Mohinder. A very good afternoon to everybody. Many thanks for giving us your time and opportunity to address you during this interaction. And as Mohinder mentioned, we will cover the entire macro and investment portion of the portfolio in about 23, 24 slides. We'll try to keep it as short as possible so that we have adequate time for a very engaging Q&A session. So in the macro portion, if you look at the macro stability, the one picture which we want to highlight is from 2010 till 2023, India has climbed almost 4 spots in the GDP ranking for the world. And in terms of fiscal deficit, compared to where we were in financial year ending March 24, the government during the interim budget has said that they will look to cut the fiscal deficit by further 80 basis points. So we will see a further reduction in the fiscal deficit, aided by very solid tax revenues, very solid collections. And these tax revenues and collections are also funding a very, very significant jump in the capex done by the government. As you can see, the current account deficit last time when we had this interaction, it was around 1.3, 1.4%. And we did say in our previous interaction that we expect current account deficit to be softening over the next 3-6 months because of reducing import oil bill and other tailwinds of exports. So we are looking at a significantly lower number on the current account deficit front. In terms of macro stability, the one picture which we want to showcase is forex reserves are very, very good at $600 billion plus. We are back to where we were about a couple of years ago. In between, we saw a drawdown in forex revenues, forex reserves, but we are, I think, back to $600 billion plus. Credit growth and deposit growth continue to remain very, very strong. Credit at about 15-16%, deposit growth at about 11-12%. The gap has narrowed, and we see this continuing going forward also. There have been some concerns about issues cropping up on the retail credit side, unsecured credit side, which is why we put up this data point in terms of the bounce rates which happen in the banking system. And if you see over the last 6-9 months, the bounce rates have actually come down. So we believe, given these data points and given our interactions with all the banks where we have allocated capital, there is no reason to be concerned about the quality of the loan portfolio on the secured, unsecured retail credit side. And the bounce rates actually give us that sense that things are normal. Consumer price inflation is normalized. RBI remains in the pause mode. They maintain the stance in the recent monetary policy that they're withdrawing the accommodation which was given during the COVID times. Again, forex reserves at $600 billion plus, current account deficit which is likely to be below 1 percentage point. GST collections, which used to be about 1.1 lakh crores a couple of years ago, are now clocking almost 1.75 lakh crores and above. And our view is that by the turn of this decade, this number should be anywhere about 3 lakh crores. And solid tax revenues continue to fund a very ambitious infrastructure creation program of the government. Even in the interim budget, which was presented recently, the government has said that for financial year ending March 25, the capex which the central government will do will increase by 11 percentage points to almost 11.1 lakh crores. PMI data is stable, ensures that we are on track both from the service and manufacturing perspective. And FI flows and the mutual fund, domestic institutional inflows continue to be very, very good. FI flows have been, a little choppy on a monthly basis, but if you look at CY23, the foreign institutional inflows have been reasonably good. Post, the state election results, I think there has been a sudden uptick in capital flows into India because the state election results did point towards some semblance of political stability, and I think that was a point from where flows have picked up. The SIP inflows continue to be very, very good. and clocking almost a couple of $1 billion every month. So if you put together that number and lump sum investments, that's almost $30 billion per annum, which is almost 1% of India's market cap and about 2-3% of the free float of this of India's equity market. Rainfall has been below normal this year. More than the actual monsoon data, what is concerning now is from a rural agrarian and food inflation perspective, is reservoir levels across the country are low. And if we don't have a good monsoon in June 24, that's a cause for concern. Toll collections continue to be good. Commercial vehicle sales and power consumption, which is indicative of economic activity and capital formation in the country, continues to be good. If you look at this picture, which we highlight every quarter, some of the data points have been updated given the change in estimates. GDP growth for F25 is estimated about 7%. Currency has been very stable for the last 1 year. Normally, the USD INR is historically looking at a 2.5% kind of a depreciation on a historic basis. But last 1 year, dollar has been by and large stable vis-a-vis Indian rupee. Interest rates remain stable. They have been at elevated levels. We've seen almost 200 to 250 basis points of increase in interest rates, both on the deposits and the loan side. So interest rates remain stable. If you look at the global economy, both Japan and the Eurozone, there are multiple economies which are going through significant slowdown. But still the jury is not yet out in terms of what the US Federal Reserve will do. So our domestic interest rates will be a function of what the global dominant large central banks do. And I think we will track those global benchmarks. So in line with that, I think the RBI has maintained a cautious stance and kept the repo rates on hold. Fiscal deficit, as I said, from 5.8% last year to 5.1% this year. Inflation likely to ease to about 4 to 5% by December 2024. So these are the 4 or 5 objectives which the Reserve Bank, the central government, the finance ministry, the entire banking system is trying to monitor, manage, and achieve over the next 6 to 12 months. Again, if you look at valuations, I think financial year till date, the market has delivered almost, as we speak today, our benchmark, which is a flexi cap related benchmark of 500 stocks, has delivered upwards of 36-37% return, indicating that we are in a very good year. Markets are rewarding Indian economy, Indian corporates, because India has emerged as one of the largest and the fastest growing economy. And in a world which is slowing down and where there is uncertainty both because of geopolitical situation and also because of concerns on economic slowdown, I think we've done exceptionally well in terms of earnings growth and also portraying a solid figure of stability across the world in terms of political stability, economic stability, policy stability, stability in tax rates, and stability in terms of a constant execution of reforms. And market cap to GDP is above 100% today. Corporate tax rates in India are one of the lowest in the world. And as we keep speaking about how strong our corporates are, there has been a steady trend of deleveraging in India. We've seen debt to EBITDA multiples come down. In fact, we will use the data from this slide in a subsequent slide where we talk about the current situation in private sector banks in this country. Banks have underperformed in this financial year till date, both from a price performance perspective and relative to the benchmark. So we'll use these data points in terms of deleveraging by the top 1,500 corporates in this country in those subsequent slides. So if you look at our current portfolio positioning, as we keep saying, we are on a very focused portfolio of about 21 companies as on January ending. The positioning is of 50 to 30 companies in the portfolio, but right now we are at about 21 companies. A very concentrated portfolio of selected set of mid and small and large cap stocks. So as we speak, we are about 10 to 11 large cap stocks and about 5 to 6 mid caps and 3 to 4 small caps. So it's like a combination of 2 concentrated or 3 concentrated mutual funds across various market cap categories, because we are using only 21-20 stocks in the entire portfolio. And given our current optimism on domestic economy, almost 80% of the portfolio is oriented towards domestic businesses across secular and consumption themes. Niche export-oriented businesses which have reasonable amount of salience of domestic revenues is about 15% of the portfolio. We are sitting on about 5% cash in this portfolio. and we don't have any allocation to commodities and cyclicals, because we believe that structural growth businesses which are linked to themes like aspirational consumption, discretionary consumption, capital formation, capex, financial services are ones which will deliver significant growth over a long period of time. So this is our sector allocation. As I said, 55% is in large cap, 24% is in mid cap, and 14% is in small cap. So you'll see a balance between small and mid and large. Large is about 55%, small and mid couple put together will be about 39% of the portfolio. And the top five sectors will be almost 65% of the portfolio. The top 10 stocks will be roughly 60% of the portfolio. And the remaining 11 stocks will be about 36% of the portfolio. So we are seeing a concentrated top and a reasonably concentrated tail of the portfolio in terms of the top 10 and the ex top 10 portion of the portfolio. We have representation to almost 11 sectors in the portfolio, representing various forms of consumption, financials, capital formation, export oriented businesses, and niche domestic oriented businesses. So these are the themes which we are positive on: aspirational consumption, consolidation across sectors leading to visibility and stability of growth and profitability, structural growth in retail credit. This is what we'll talk about in one of the subsequent slides. Niche manufacturing exports across industries like agri inputs, pharmaceuticals, and automobiles is what we are very bullish about. The infrastructure creation, which is enabling consumption, enabling job creation, enabling capital formation, is what we are bullish about. These are the themes we are positive on. So if you look at financials today, over the last since April 1, 2023 till now, financials have underperformed. Uh, Typically, in the beginning of the interest rate hike cycle, banks have done well because they were quick to pass on the rate hikes to the end consumers while the cost of funds were benign. But I think now we are seeing, while the industry is looking at a structural growth, there are some transitory challenges which we want to talk about. The first being a very tight liquidity situation and slowdown in deposit growth. There have been a pace of regulatory changes like increase in risk weights for unsecured loans and other forms of retail credit. There has also been in a situation where a predominant portion of government's liquidity is sitting with RBI, and given elections and given some seasonal slowdown in government spending, we are seeing tight liquidity situation and also solid growth in term deposits, but a very slow growth in the CASA part of the balance sheet. This impacts banks because the cost of term deposits has increased significantly. Anywhere between 6.5 to 7.75 is what banks are paying today for a deposit of, say, 9 to 18 months. So that itself has its own impact on net interest margins and growth in NII. If you look at Indian banks, the top four banks which we have invested in, the top five banks in India, they have demonstrated that India is the only country of its size in terms of GDP where banks and financial institutions can deliver a consistent net interest margin of almost 3% plus at scale. When you talk scale, we are talking of five, six banks which are running balance sheets of almost $500 billion and above. So at that scale, they are demonstrating 3% NIM, not wholesale banks. They are very granular retail portfolio across mortgages, personal loans, auto loans, and other forms of retail and SME credit. So these are very granular portfolios in a way NIM is being delivered on a scale that demonstrates that banks have historically showcased their capability to scale and deliver excellence at scale. And if you look at our cycles in the last 10, 15 years, even if you include COVID years, we had a credit growth CAGR of almost 10 to 11% across cycles of global financial crisis and the COVID related crisis and the period of policy paralysis in between. We've grown almost 10 to 11%, and we believe that over the next 5, 10 years of India GDP has to grow around 7 to 8%. We require credit growth to be at least between 15 to 20%, and that's the long term growth perspective which we have for the four banks which we own. Whenever we interact with these banks, they have said that these are challenges which come during high interest rate scenarios, and because of RBI's liquidity tight liquidity situation, I think we are going through this. But I think as we take a 5 year, 10 year view, we believe that if you have to sustain this kind of a GDP growth, we need solid banks and we need credit growth to fuel that GDP growth. And there are also institution specific challenges. There are mergers, there are integration challenges because HDFC and HDFC Bank have merged. Axis has acquired a portion of Citibank, and that's largely behind in terms of integration of the teams, integration of technology, and private sector banks collectively employ almost 7 lakh people. And we've seen attrition of almost 40% plus in certain institutions. So there are transitory institution specific challenges which the industry has dealt with. So we believe that, historically, over the last 5 years, we've seen that banks which have demonstrated a track record of prudence, very solid balance sheets with enough capital buffer and enough contingency provision buffers to take care of any sporadic spike in non-performing assets is what we have invested in. We've also invested in banks which have demonstrated that over 5 to 10 years they can deliver significant growth. And we also believe that near-term challenges will persist, and valuations have, because of these near-term challenges and uncertainty, valuations have turned very, very attractive. Some of the banks on a price to earnings and price to book basis are quoting a significant discount to their historic valuations. And we believe that in the portfolio, we need to have margin of safety. And today, private sector banks offer significant margin of safety, both from a long to medium term perspective. So if you look at this slide, what we've said is, apart from building significant franchises on the lending side in terms of building granular retail portfolio and a very solid wholesale banking business, Axis, HDFC, and ICICI have also built solid franchises in the asset management, life and general insurance, and the capital markets business, which is essentially the disintermediation portion. These can account for anywhere between 5 to 10, 5 to 12% of the uh, consolidated profit and the consolidated net worth of these banks. And if you look at, what is driving this credit growth and why are we seeing growth across, whether it is retail, secured, unsecured, SME, rural credit, what is driving this sustained growth in credit? We personally believe, and we as an institution believe, that between 2016 to 2023, the kind of reforms India has implemented, right from demonetization to GST to tax compliance to implementing UPI, Jandan accounts, I think that has enormously increased the penetration of banking system among small businesses, individuals, and people who used to do business purely on cash. And once you are part of the UPI system, you leave a credit trail, you leave a payment trail, you leave a trail of your financial capability. And today, these technology-based tools and these new way of payments is ensuring that there is enhanced access to credit. And bankers are today using GST returns, using UPI payment data, spends data on credit cards, the data which comes from account aggregators, to improve their assessment capability of an individual borrower or a corporate borrower. So we believe that the long-term growth is not only because of economic upturn, but also because of reforms which we have implemented in the last 7, 8 years, which have ensured technology, which have ensured a newer way of assessing credit, which have ensured that, the so-called frictionless way of delivering credit to credit-worthy customers, and using technology to scale this retail credit and SME credit businesses. And we also believe that, we are at the beginning of a capex cycle. And even though large cap companies and the top 50, 100 companies don't borrow to create capacity, we believe that their ecosystem vendors, channel partners, dealers, and the jobs which these companies can create because the capex will definitely lead to a lot of improvement in the credit demand from SMEs and small corporates. And we believe that whenever the capex cycle starts from the private sector side, the banks are well positioned to cater to that demand. And apart from the retail credit growth, which has happened in the last 5, 10 years, uh, once the corporate credit growth starts, I think you will see significant amount of improvement in the credit growth from a banking perspective. And one more perspective on cost of funds and deposits, we believe that you require low interest rates for an economy to do well and for the capital cost to come down. But in India, I think the cost of funds is a multi-layered metric, not because of the economic realities, but because of the fact that a whole host of people who are retired, uh, people who don't have access to the government pensions, depend purely on banking system for their, the interest income which comes from their banking accounts is the sole source of income. And cost of funds typically don't come down because there are government administered savings schemes where interest rates are very, very high. You have an inflation which is about 4 to 5%. So cost of funds on the fixed deposit side may not come below 5.56%, and the savings accounts remain at around 3 to 4%. So even if you want a low cost of funds on the economy side, I think it's a very difficult thing to accomplish in a country like India, So we believe that even with this kind of a cost of funds, banks have demonstrated capability to deliver 3% plus net interest margin over a long period of time. So we want to re-emphasize that we've invested in banks which have a sound operating history of risk sensitivity, underwriting capability, solid technology adoption, and last but not the least, scalability. You've sitting on banks which collectively run a balance sheet of almost $500 billion. So we are very positive on their medium to long term prospects. As I said, near term challenges they will be there because of the ongoing interest rate and the liquidity scenario. And we continue to run about 22% weight in banking as we speak. These are some of the key portfolio constituents: banks, consumption, telecom, automobile OEMs, agri inputs, discretionary consumption. These are some of the key portfolio constituents. Some of the earnings growth numbers for the quarter. As I said, banks PPOP growth has been under pressure this quarter, which is why you see a 4% EBITDA growth for banks. Ex financials, the remaining portion of the portfolio, which is seen revenue growth under pressure because of slowdown in rural markets and slowdown in our consumer businesses, especially the home appliances, home improvement, the consumer electricals businesses have seen pressure on top line growth. But the bad growth has been mainly because of savings in raw material cost and some of the exponential companies in automobiles and FMCG and hospitals and telecom sector doing well. We've delivered 15.8% in PAT growth for the ex-banking sector. At a portfolio level, I think we are hoping that the revenue growth should be significantly higher than where it is today. Even EBITDA growth should be significantly higher. We've also adjusted these numbers for some one-offs from some of the portfolio companies. So as a result of this, we are seeing almost a 13 percentage point kind of a portfolio earnings growth. We believe that given the concentrated portfolio and given the kind of businesses our portfolio companies are present in, we see medium to long-term drivers to deliver healthy earnings growth. So some of the leaders versus laggards, pharma, hospitals, FMCG, the organized retail, discretionary consumption, and telecom has been sectors where we are overweight and they've contributed to alpha. And especially cyclicals, which is mainly capital goods, real estate, oil and gas, and some of the PSU stocks which have done well. We've been either absent from those sectors or uh, we've underweight there, which is why I think we've foregone alpha in those sectors. And commodities underweight and IT service underweight has played out well. Consumer durables is yet to play out. Agrochemicals and financials are yet to play out. They said they have adversely impacted our portfolio alpha. But overall, I think if your earnings growth is in place over the next 1 to 2 years, I think things should come back to normalcy in terms of an alpha generation for the portfolio. So Varun Beverages is one of the largest position in our portfolio. It's Pepsi's largest bottler in India, and we keep showcasing this stock as a company, where they've demonstrated scalability, operating efficiency, inorganic expansion, product launches, and a combination of all these market-related factors and phenomenal operational and process rigor to deliver significant results. So if you look at between 2017 to 2023, the revenues have grown fourfold. The PAT has almost gone up 9-10x, and market cap of the company has grown up almost 11 to 14x in the last 6-7 years. So we keep reiterating that in a consumer franchise or in the consumer facing businesses, we look at a combination of these factors, a management team which is continuing to execute very, very well, not only in India, but also overseas markets, expanding its opportunity set and expanding its uh, addressable market, not only in India, but also outside India. So historically, they were only in beverages. Now they're also entering into agreements with Pepsi to start packaged foods business for them. So I think these are significant opportunities in front of them over the next 3-4 years in India, overseas, and we believe that these factors should drive growth for them going forward. So this is our performance track record. As I said, FYTD, because of the sharp recovery in the markets between December to Jan, our alpha, which was almost 2-3 percentage points, has gone to -5. Since inception, we are almost on track to, in line with the index in terms of 30 versus 30. So as you see, between December 23 to Jan 24, markets up 10%, we were up 4%. Till November, I think we had an alpha of almost 6 percentage points. And April to November 23, we had an alpha of almost 3 percentage points, which is slightly dipped into the negative in the short term. But we believe that if your underlying portfolio earnings growth is intact, and if your portfolio has a good mix of businesses which are plugged into the growth parts of the economy, over medium to long term, I think we should be able to deliver significant upside in terms of portfolio absolute returns and also alpha. But historically, we've observed, over the last 15, 20 years that whenever the index return for a financial year goes above 25%, the last 10, 15% of the return typically comes from sectors which may not be what we would tend to participate from our philosophy perspective. These are businesses which are high beta, deep cyclicals, which we don't participate in our portfolio. As you can see, our portfolio is whether it is a large cap or a mid cap or a small cap, they are clued into consumer facing businesses, businesses which have scale, businesses which have hygiene in terms of cash flow generation, businesses which have hygiene in terms of uh, capital efficiency. I think those are the businesses which tend to do well over long periods of time. They may not be able to participate in every move of the market. And historically, if you see a 2 month return of 10, 11% is not sustainable. So we believe that we will come back in terms of a reasonably healthy alpha number over the long term. So I'll pause here, Mohinder. We can take questions from here. Thank you.
Thank you, Raghavendra, uh, for the update on the Enam India Vision portfolio. I think, Raghavendra, if you just go to slide number 18, if I may request that on the screen. I think very important that slide number 18, which is, the current construct of the portfolio. I think for everybody's, and I've got a couple of questions while, you were speaking across, right? I think that's something that at Enam, we have always followed while we've been focused and concentrated in our approach of managing the portfolio in a disciplined manner. We are well diversified. When you look on the right side, which is the sector allocation, so it's very well broad based. It's a reflection of the depth and the breadth of our understanding as an entity. Because as an entity, in our existence, we have practiced and understood, in our own manner. We obviously complemented by external research providers, but the team that is at hand, as I started during the call, which is a 17-member investment management team. I think what you see is the conviction, is it's the bet concentration in the current portfolio of Enam India Vision portfolio that is there, which is reflecting the opportunity that we see as a manager in various sectors that we are participating, and the businesses that are getting represented as an outcome from our conviction. And on the left is the market cap orientation. So given the current juncture and the recency, uh, factor in the way the markets are moving across, which has also surprised few too many. We at Enam stay our course in ensuring that the quality and the orientation towards the conviction and towards the companies that we are buying into the portfolio stays good. It's a very well balanced portfolio between the large and between the mid segment of the market. Just to give you a perspective, it is the segmentation basis the market cap definition that we have put it across. But even the mid part of the portfolio or the small part of the portfolio are actually the top two or the top three in the sector that they are operating under. So they are mid from the market cap point of view, but they are large in terms of the sector market share point of view, in terms of the dominance that they have. That's something that we at Enam lay a lot of focus in terms of ensuring that there is not only stability, but there is the execution capability for the companies to keep delivering on an earning growth that is in excess of the indices that we are representing, which is the broadest indices that we have, and also for the fact that we have a very high active market share. So the team at Enam has always ensured that we give our best in terms of our understanding in the portfolios that are today constructed as we speak across. And typically, the gap, which is the positive gap between the market and index and our portfolio, has been between 300 to 400 bips to as much as high as 800 bips, which is 3 4% to 8% in the earnings growth that we target in our portfolio. That is the way we are looking across with very high return on equity that we target to ensure that it's a sustainable earning trajectory that we are participating. And essentially, as the feedback that we get from you all, and as has been well researched from your end, we are flexi cap, and at the same time we are GARP oriented in terms of our approach when we buy and when we stay invested in the portfolio. So we are fine to lose time in some basis, but not capital. And that's how the quality orientation happens. And in terms of our approach towards being a GARP oriented portfolio, which is growth at reasonable price, we want to ensure that there is that margin of safety at all points of time that we at Enam tend to follow as close as possible and as disciplined manner as possible. So with this, I will open the floor for Q&A, for you all to type across and for us to take it across as we speak. Also, very importantly, the portfolio from a features point of view, as always, we've never locked in our clients' money. So we don't even have a single day exit load in the strategy that we run or represent ourselves. On the domestic side, that we have today representing in our offerings that we are discussing with you. So it's a very client-centric approach that we tend to follow at Enam. With this, Raghavendra, we move to the Q&A session of the webinar. The first question, Raghavendra, for you is, what's the portfolio valuation metric, which is the PE and PB, relative to the market and benchmark? And how does this current delta compare relative to the history? And how does the portfolio earnings growth compare to the benchmark? While I think I have answered to some extent, but Raghavendra, I would request you to dwell a bit deeper on this
Sure.
question. Thank
So we normally use for the banking portion of the portfolio, we use price to book multiple. As I said in my slides on the banking sector, the valuations today for banks in our portfolio are at a meaningful discount to the historic valuation multiples. In our consumption and non-banking portion of the portfolio, we have businesses which are very, very divergent. There are companies which are leaders in telecom services, automobile OEM. There are companies which are operating in the home electrical space. There are companies which are operating leadership franchises in multiplex industry. There are niche pharmaceutical companies and agri inputs companies. So we use for those companies, depending on their capital structure and depending on historically what kind of valuation framework we have internally used, either in price to earnings multiple or EV to EBITDA multiple. And for the banks, we use a price to book multiple. And we also see that, given that banks will not be raising capital in the foreseeable future, barring some very, very big growth opportunity, we also tend to measure banks from a price to earnings perspective. Typically, you use either a price to book or a price to earnings. So we want to share that, while these metrics are commonly used to measure the portfolio, what we say is the banks are anywhere between 1.7 to 2.5 in terms of the price to book. If you measure on a F25, F26 forecast basis, and most of the consumer facing businesses which we own in our portfolio are trading anywhere between 30 to upwards of 50 multiple, and businesses like Maruti, businesses like Bharti Airtel, we don't use price to earnings multiple for some of these businesses because they sit on significant amount of leverage on their balance sheets, or they sit on significant amount of cash in their balance sheet, depending on which company you're talking about. So we normally don't uh, subscribe to the philosophy that you should have a portfolio PE and a portfolio price to book. Those are company specific measures. A portfolio which has 25% or 22% weightage to banking, there is no technical usage of a price to earnings multiple. So we tend to look at each and every company. Yes, in consumer facing businesses like say Metro Brands or a Titan, the valuations are at a premium. But at the same time, if you look at a PVR or a company like TTK Prestige or a company like say Sumitomo, they are going through their own challenges in their industry. So the valuations in industries which are going through transitory pain or transient challenges are at a discount to that extent. A PVR could be if you forecast their profits for 25 and 26, or even if you look at their scale, they are likely to grow at least 10-15% every year, given the expansion in footprint, given the expansion in pricing, given the opening of new revenue streams. So I think that's the way we look at it. I don't we never publish portfolio level PE or portfolio level price to book. For the vision portfolio, we normally look at growth metric, and then each and every sector we publish our forecast in terms of what is the trailing price to earnings or a trailing price to book multiple. We can take the next question, Mohinder.
Sure, Raghavendra. Uh, the next question, Raghavendra, is what is the thought process with regards to consumption in terms of the theme play? And also, let me, Raghavendra, combine another question, which is linked to the same theme per se. Uh, we have seen slowdown in revenues for consumption sectors such as consumer durables, home improvement, footwear, multiplex. The theme that which is we are playing is aspirational consumption, according to the the questionnaire. What do you think will drive the recovery in consumption? Thank you.
Sure. So I'll take the first question. I think what you mentioned was, what's our view on consumption in theme play? As I said, we are in consumption, we are more oriented toward discretionary consumption. In staples, we only own Varun Beverages, which is we believe that grows at a much faster pace than typical FMCG staples companies, which grow at low single digit or high single digit. This company has demonstrated growth of 15-20% plus for the last 5-6 years, and we expect growth rate to continue in the FMCG space through a company like Varun Beverages. In the non-staple space, what we own is a set of discretionary companies. Through PVR, we are playing the multiplex theme, which is essentially spending time outside the home with your family members and watching uh, content which can be consumed as a family or as an individual. If you want theatrical entertainment, it's 40% market share of India's box office revenues. We are also invested in a company called Maruti Suzuki, which is upwards of 40% market share in passenger vehicle space in the country, and has done significant amount of product launches in the last 1 year and continues to gain share in the SUV market. We are also represented in the organized retail through companies like Titan, Metro Brands, which we believe are uh, very, very good markers of aspirational consumption. And in terms of home improvement, what we own is a company called Century Ply and companies like Bajaj Electricals, TTK, and Havells. So that gives you a mix of the entire, new housing starts and home improvement theme. So I think those are the companies which we own from the consumer side. Also, if you look at Bharti, it's a quasi consumption play because data consumption and consumption of telecom services is a big theme in India, and the entire digital revolution which you see is driven by soft telecom broadband prices, and we are seeing phenomenal penetration in telecom services. And the play there is that forward 3, 4, 5 years, we should see significant improvement in pricing of telecom services. And in terms of the seasonal slowdown we are seeing in consumer electricals and some of the businesses which you highlighted, what we believe is you have to have a mix of businesses which are doing well currently and a mix of businesses in the portfolio which might be going through a transient slowdown in a structural growth story, which is why we have a mix of businesses like Titan and Metro Brands, which are growing very well. And we have also businesses which are currently going through a short-term slowdown in terms of home appliances and consumer electricals and home improvement. And the long-term drivers for these sectors are in place to deliver growth upwards of 15% on a sustained basis. And that's why we continue to own these stocks. And of course, the reasons are many. During COVID, there was a boom of home appliance consumption and consumption of certain products. And post-COVID, there is a seasonal or a short-term slowdown. We believe demand should come back. Commodity prices are soft now. Aluminum, copper, steel, all sorts of petrochemical related raw material, the prices are soft. And we expect these sectors to do well going forward. We can take the next question, Mohinder.
Can you elaborate on the chemical industry? Why is it underperforming, and do you think this will change for better in 2024?
I think the chemical industry did very well if you take the last 6, 7 years. And if you leave out the last 18 months, I think the chemical sector has done very well, both from earnings growth and the return perspective. But I think last 12 months, there has been significant uh, I think underperformance in chemical companies because of the fall in commodity prices, chemical prices, and also the dumping by China in certain product segments. And now we have to going forward, we have to see how raw material prices and volume growth for Indian players pan out. And I think that's the way to look at it. What we own in our portfolio is a small company called Sumitomo Chemicals, which is majority owned by a Japanese MNC, with significant amount of technology and product support coming in from the parent company, and which is also positioned as a supplier for parent's global associates, and also has a solid domestic retail presence and a retail branded business in India. And we've seen prices of certain products like glyphosate fall very sharply in the last 6 to 12 months. And I think any business which has linkage to global commodity prices or where there is supply from global markets will go through this periodic phase of slowdown. And I think if you're selective, if you're invested in companies which have branded portfolio, which have technology access, and which have not only domestic market but global market to grow. I think we should deliver significant alpha. But purely investing in a commodity company is not something which we are wanting to do in the commodity chemical space or in the specialty chemical space. We can take the next question, Mohit.
Thank you, Raghavendra. In one of the slides, we have shown the P of the mid caps has shot up above +1 standard deviation. What is the view on the mid caps and the vision portfolio?
So I think that the benchmark which we showed, the valuation which we showed was for the benchmark. As I said in my initial remarks, India has been rewarded phenomenally in the last 12 to 18 months for demonstrating that we as an economy and our top 500 corporates can grow irrespective of whether there is COVID or a Ukraine conflict or a Israel conflict or a Red Sea situation. I think whenever you deliver growth, and especially growth when you are relatively outperforming versus every other major economy in the world, and also stand out as a unique economy, both in terms of its composition, demographics, political stability, you tend to get rewarded disproportionately. Which is why I said FYTD, our index has delivered 36%, and the typically return you will get in 2 years. If you look at a long-term track record of index return, 12, 13, 14% is what you make from any index in this country. If you take the long-term flexi cap index return. So we've demonstrated that in 1 year, we've got almost 33, 34%. So I think the valuation you see in terms of the premium is what the +1 standard deviation kind of depicts in that slide, which also means that some of the mid cap stocks are trading at premium valuations. And our mid cap, the companies which we own in our portfolio, as I said, it's a mix of businesses. And while we have some companies which are trading at premium valuations, there are also companies which are going through a temporary stress, which is why you're getting to buy those businesses with a good amount of margin of safety. So that's how we balance out the valuation mix. Don't buy everything at a significant premium. Where you believe that it is important for you to anchor the portfolio in a solid high growth large cap, and there is a premium which you need to pay, you can pay that, but you will not construct the entire portfolio based on high quality premium. That's an anchor for the portfolio for maybe a small 6-7% of the portfolio, but there needs to be a significant amount of focus on valuations what you pay, because if you pay an undue premium, maybe you will not make significant amount of upside in the near term. So those are realities which we are very conscious about, and we tend to take these things into account when you buy a TTK, you're also buying a Havells. When you buy a Metro, you're also buying a company like APL Apollo. So you're mixing businesses across the mid cap curve, and technically some of our mid cap companies are leaders in their sectors. As I said, PVR is one of the smallest companies in our portfolio in terms of market cap. It's again going through its own stress in terms of quality of theatrical content and success. But again, it's a 40% market share company going, available at a market cap of 13,500 crores. So I think that's the kind of mid caps which we own. We don't own for example, in industry where there are 30 players, we don't go and buy the 20th player in that industry. We typically tend to buy the top three, top four companies in the mid cap or small cap space. So the emphasis is always on companies which are likely to be in the top three, four players, and industries which are benefiting from formalization, growth in their categories, growth in addressable markets. So I think that's how we would position ourselves in the mid cap space. Yes, there is a certain amount of froth in mid and small caps. You've also seen a lot of data points go around in the market in terms of what kind of returns some stocks have given in 1 month, 2 months. I don't think those are sustainable returns. It's good to showcase that kind of data points in terms of a recency bias, but I don't think those are actionable returns from a long-term perspective. We can take the next question, Mohit.
Thank you, Ravindra. I think adding to your answer that you just gave across, I'll put across a question which says, how do we fare regards to 1 year rolling return versus the benchmark?
We don't have the data offhand, and our product is 1 year old. So for you to get a 1 year rolling return, you need to have a data points of 2 years. Uh, we've showcased our return in our initial slides. So we are currently slightly below the benchmark in terms of on a 1 year basis, and we are delivering a very healthy absolute return of almost 30 percentage plus, which indicates the quality of some of the companies, their quality of growth, and their capability to also command good valuations in the market. So that's how I would put it. But we don't have a 1 year rolling return as of now. You can take the next
Thank
question,
you.
Moin.
Thank you. We talked about capital formation as a theme. How much of the portfolio is in that theme? And is the portfolio underweight or overweight because of that on that theme?
As I said, capital formation in an economy is more of an enabler, is more of a hygiene in certain sectors. For example, you want to set up a manufacturing industry. If Maruti today want to expand capacity and go to, say, 3 million units, you need power, you need roads, you need ports, you need uh, digital infrastructure, you need educational institutions to supply the manpower, and also you need a healthy and vibrant market for them to be able to sell their products. So these are all infrastructure and capital formation. So the biggest emphasis for the last 10 years in this administration has been in creating roads, creating power generation, creating enough educational institutions to supply engineers and professionals to run these factories to get us to the top end in terms of manufacturing expertise. Today, when we talk about semiconductor or any other form of investments in India or alternate energy or hydrogen, these are all industries which are not there in India over the last 5, 10 years. So you need a real new set of expertise and new set of talent to cater to these industries. So don't look at capital formation just in terms of a road or a port or a power project or a or a urban connectivity project. We look at capital formation in its holistic view, which is that if you look at the portfolio, the biggest infrastructure which this country will demand over the next 10 years is healthcare infrastructure, which is why we invested in a company called Medanta in our portfolio. So we are present in capital formation through companies which are in the banking space, through companies which are in the automobile space, through companies which are in structural steel tubes, and also beneficiaries of all this infrastructure and capital formation is discretionary consumption. Because when you have good power, you can sell a soft drink even in a village, because without power, there is no market for soft drinks in a village. So, which is what has been driving growth for Varun Beverage in the last 5 years, that electricity has reached the smallest village in this country. And there is a market for them in those places, which historically were not served, which is what driving their long-term growth. So I would say we look at capital formation and infrastructure creation from a holistic perspective. And those are spaces which we have invested in our portfolio. Finally, I also want to say that in our portfolio, we'll by and large have 20 to 25 companies. So we will have to sacrifice certain sectors. So we can't have a representation for every sector and every theme in the portfolio. What defines our long-term track record is also what we avoid apart from what we own. As I said, we will not own cyclicals. We will not own businesses which have no cash flow conversion, which have no cash flow hygiene. And those are spaces which we're happy to stay away from at this point of time. Mohinder, we can take the next question, please.
Thank you, Raghavendra. The participant is asking in one of the slides that we have represented that not being an IT has helped the alpha for us. Do you think we should have some allocation to IT now as they have underperformed in India and US tech companies have reported good results?
A good question. I would say we are watching the entire space very closely. And I think sometimes in certain sectors, it is better to participate after you see visible signs of recovery rather than second guess what the companies will do. So, as and when we see structural ingredients for a IT recovery to be in place, we will be more than happy to participate. But currently, as I said, IT sector gets a demand from global economy, and some of the markets in which these companies participate are going through their own challenges. And there is also a technology disruption happening in the IT service industry in terms of AI and the related technologies. As market participants, I think we need to understand these changes in IT industry before we allocate your capital. I can't base capital allocation on some guesswork on what will do well. So we will see visible signs of recovery. And whenever we see that there is a scope for us to make money on a 5-year basis, we will go and participate in those spaces. So currently we are, in a watch mode in the IT sector space. As I said repeatedly in our historic calls in the last, I think this is the fourth or the third interaction we are having. We've stayed away from the sector and it has worked out well. And structural growth for the sector, if you take the last 10 years, is about 11-12%. So our growth aspiration is slightly higher, and I think that's what we try to highlight in our portfolio, that we will participate in businesses where the growth on a structural basis is at least above 15%. We can take the next question, Puneet.
Thank you, Raghvendra. Would the portfolio ever invest in PSU or public sector bank stocks? Don't some stocks or slash companies filter better than others and merit an addition to that sector or participate?
Now, as a house, we've always maintained that management team, the continuity of the management team, the incentives for the management team to deliver results in line with shareholders or minority shareholders' interests, and discipline in terms of capital allocation, and also a thought process of the management that what they want to do over 5, 10, 15 years. I would also want to believe that the current optimism in PSUs is also because of a very, very favorable political environment. And tomorrow, if there is any change in the political environment, I won't want to come to my clients and say, I did not know what will happen with the government. We took a bet on PSUs and sorry, we couldn't do well. We didn't do well. So that's not the answer we can give to our investors, because they have given us money for investing over 5, 10 years. And based on some recent outperformance or 6-month outperformance, we don't want to take very, very large transformative decisions like adding PSUs to our portfolio, which we've not done in the last 20 years because of the reasons I enumerated in the beginning. That there is the management teams change very frequently, and a lot of shareholder value creation is also a function of what is the political formation at the ongoing point of time. And these companies have done very well in the last 1 year, but take that 10-year track record, 5-year track record. So I think that's where I think we are a little cautious. And we've also highlighted to clients right at the time of starting this portfolio that as a house, don't expect us to go and buy 50% PSU or 40% PSU in the portfolio. We've never bought PSUs, and we will. And you also see that we've avoided conglomerates, we avoided commodities, we avoided deep cyclicals, we avoided businesses where there is no cash flow hygiene. And I think that's what we will probably maintain. We can go to the next question, Meeta.
Thank you, Raghvendra. Given that the current market cap of GDP is at an all-time high, would it be advisable to deploy a fresh fund now?
So I think the entire market cap to GDP question is also need to be looked at from the perspective that if you go back 10 years, a lot of companies are, a lot of parts of the economy today which are represented in the market cap were not even listed. Okay. Hypothetically, a Zomato was not existing at that point of time, but today a Zomato exists in the market cap. The entire railway stocks, the entire manufacturing stocks, the entire PLI related stocks, the entire listing of insurance companies, listing of asset management companies, listing of a lot of companies in the organized retail space. They were all vibrant parts of the economy over the last 5, 10 years, but they've all come into public space and become part of the market cap because they just got listed. And we've seen phenomenal number of new companies become part of the market cap. They were always part of the GDP, but they were not never part of the market cap. So which is why you see on a structural basis, our market cap to GDP has gone up in the last 3, 4 years. Plus, if you see a market which has gone up 33, 34% in a matter of 12 months, you will also have a benefit of that in the market cap, in the numerator, which is why you see the number, the ratio a little high. And what we've been maintaining to our investors is that you have two ways of looking at how to deploy money. One is if you have a 5 to 10 year time frame, there is very little merit in timing the markets. And second way of looking at markets is if you are little apprehensive about where the market is today. We have a STP option. You can come into our fund through an STP option and invest in 5, 6 branches. And that's the way. These are the two vehicles. And definitely you should consult your financial advisor, look at asset allocation, and then appropriately allocate capital to our fund and to the equities and asset class. You can take the next question, Moin.
Thank you, Raghavendra. We haven't churned our portfolio since inception. Given the run up in the stocks, don't you think there is an opportunity to add stocks with reasonable valuation and exit some that have run up?
I think what we've done in terms of portfolio level actions is wherever the weightages have gone up significantly above our initial rates, we have taken certain, I would say, weightage reductions or trimming of weightages, and certain changes in the portfolio, which we on an ongoing basis take. We will communicate to our clients a fair question that, given the kind of market volatility and given the kind of returns we've seen, normally it is expected. But as we've stated in our philosophy and our positioning, we are long-term investors. We don't tend to get in and get out of stocks very frequently, and it's better to stick to what you state as a philosophy and remain long-term investors rather than selling X and buying Y and then going and looking at Z every 6 months. So we are very, very positive on the companies which we own in the portfolio. As I gave you the entire list of stocks across banking, across consumption, exports, and the manufacturing space which we own in the portfolio. And we meet these companies every year, every 6 months. And whenever we meet these companies, we look at the long-term promise these companies hold. And once you get out of a long-term compounding franchise, it's very difficult to go back to the same company. So we are not in the business of selling at 100, buying back at 90, and on an ongoing basis. So we would keep the portfolio churn very low, and that's one of our promises to our investors, that we don't churn the portfolios every day. We take very calibrated and very measured, prudent decisions whenever we exit or enter companies as a whole. We might trim weightages, but to exit a company completely, we need certain factors to work in the background to take the decision. But a very prudent and a good suggestion, and we'll keep this in. Thank you. We can take the next question, Mohinder.
Yes, we move on to the last two questions for the webinar. The penultimate question, Raghavendra, is our view with regards to the small and mid cap risk premium for the coming 2 to 3 years.
I think mid and small caps will continue to grow on a structural basis, maybe 2 to 3 percentage points. The mid caps, the quality mid caps, because of the smaller size and because of the increasing uh, addressable market, because of formalization, because of increasing income levels, increasing consuming population for these specific categories. There could be higher growth rates for these companies, and some of these companies also uh, go through phenomenal stress during times like COVID and Ukraine and any domestic slowdown. So I would say that, as long as structural growth on a 5-10 year basis is delivered, I think you will see the risk premiums remain under control. For example, as we demonstrated in our case study, 2017 Varun Beverages was a small cap company. Today it is a very big large cap company in a matter of 6-7 years. So we are nobody to say what is a large cap and a mid cap purely based on size. We need to look at the business on a 5-10 year basis and then assess and accordingly decide our allocation and weightages to these businesses. And this is a portfolio which has a healthy mix of mid and large caps, and some small representation to companies in the small capitalization category. And accordingly, we'll manage the portfolio. We can take the next last question, Mohinder. Thank you.
Thank you, Raghavendra. Yeah, I think the last question is yes. So I think coming to the broadcast for this webinar, yes, we do upload the webinar recording on our YouTube channel, which is at the rate enamamc.com. We will also share the recording of this webinar on your registered email ID, which will be shared with you shortly, as well as we will broadcast it via WhatsApp medium also to the participants so that we've got a lot of questions. If we can have the recording to be shared across, absolutely we'll do the same. And as we look at to closing this webinar, all I want to say is that I thank you once again with all the gratitude on behalf of an AMC to entrust and give us this opportunity, to be together, and to the families who have invested. We sincerely thank you for being with us all through our journey. And we look forward to staying connected and ensuring that we be as consistent as possible to what my colleague Raghavendra has just walked us through in terms of our thought process, our philosophy that has been time and tested across the market cycles that we have existed as an equity house. And we promise we will do our best to the ability that we possess to ensure that we stay focused, and deliver on a sustainable long-term rate of return that we state as our objective while we grow this capital for you in the coming years to come. Raghavendra, closing remarks from your end, please.
Many thanks to everybody for joining this interaction. And we will again have an interaction in the very near future. And as I said, we are very excited about the growth prospects for the businesses which we own, and we'll continue to monitor and assess their prospects and take suitable actions in our portfolios from a long-term prudence and a fiduciary perspective. And many thanks for giving us your time. Thank you.